Thank you, everyone, for coming in. I am really excited to welcome you guys to this maiden edition of a debate on the Idle Park Talk Show. Tonight's debate will not be possible without the ingenuity and the vision of the founder of the Proud of Who We Are WhatsApp group, DJ Ray. I deeply admire this group and what it has done in its short existence to bring our veterans of Cameroonian origin together so that they can share their businesses, they can share educational opportunities, leisure and pleasure ideas, and, just to enjoy each other's company. I assume we are here because we care about the spirit of an engaging and an informative exchange, even with people with whom we disagree vehemently on a certain topic of interest. In this particular case, life insurance. Now we live in an era of information overload where understanding insurance can be complex and challenging. There is a lot of insurance-related information available to us on our phones, on TV, on radio, on social media, just about everywhere you turn. Yet, I know so many people who struggle to decipher what insurance product is good for them, what works for their lifestyle and their families. Here at Idle Park, we believe that information should be utilitarian. By that, I mean, it should be as good as the outcome in the lives of the people who consume it. It should be simple to understand, it should be actionable, and more importantly, it should be measurable. We also believe that disagreements should not be spiteful or mean-spirited. They should be cordial and open-minded. Our forum allows people to wrestle with complex ideas in a manner that is respectful and educative, which is why I could not be more thrilled to introduce to you the proposition tonight. Is permanent life insurance a scam? In many ways, this is an important question, not just because of the implication it has in the lives of policyholders, but the potential meaningful impact it has on their offsprings. According to Canadian Life and Health Insurance Fact Edition 2021, 22 million Canadians have life insurance coverage, totaling $5.1 trillion, and 26 million Canadians have supplementary health insurance. That's a significant chunk of Canadians. In general, there are two types of insurance, and I'm sure our debaters are going to expand more on this. There is the term insurance and the permanent life insurance. Term insurance provides cost-effective temporal coverage with premiums that typically increase over time in 5 years, 10 years, 20 year steps, while permanent insurance is meant to mean lifelong protection needs. There are two types of permanent life insurance. There's the universal life and the whole life. With all this information and combined with the knowledge that our guests are going to share with all of you guys, naturally, a lot of people have a lot of questions. What is life insurance? Who does it benefit? What are the conditions of the life insurance products that I have? What are the implications to me? Is permanent life insurance a proper way to invest for my future? Will it benefit my children? In other words, is permanent life insurance a scam? With that said, allow me to introduce to you the participants of the debate tonight. Arguing the affirmative that yes, permanent life insurance is a scam, please meet Ebenezer Castro Castro. Castro is a life and mutual fund licensed practitioner in Alberta and in Ontario since August 2013. He also doubles as a regional leader at Primerica Financial Services. Castro's experience in the industry spans a decade and comes from him being a victim of permanent life insurance himself. Over the decade, he has educated clients who own bad policies and has helped them put their finances back on track. When Castro is not helping people in the financial realm, you can catch him golfing in the summer. So arguing that no, permanent life insurance is not a scam, please meet Mrs. Margaret Mbakwa Tanwani, Maggie as she's known. Maggie is an independent senior broker with World Financial Group. She has access to many insurance companies, banks, and investment houses. She is an insurance licensed practitioner in Alberta, Saskatchewan, New Brunswick, and Manitoba since 2020. She loves to educate families on how money works in Canada, and by so doing, help them achieve their financial dreams and goals through an array of products, part of which is term and permanent insurance. When she's not helping families, she loves spending time and doing activities with the youth. Okay, now let me explain the rules. So first, we're going to start with each debater getting 5 minutes to make an opening statement on the motion. I'm going to start with Castro, then Maggie. Then they're going to have 2 minutes rebuttal. So each debater will have 2 minutes to rebut the other's position. Then we're going to go into questions and answers, where my co-host will coordinate all the questions from the public. At this point, debaters can interrupt each other and make corrections and expand on the point if they deem fit. Please, audience, save all your questions for this part. Finally, we're going to have 2 minutes for each debater to make their closing remarks. I'm going to have the timer on my phone, and I will signal each debater when they have 1 minute so that they can round up on their position. So please, audience, remember that the debaters are not here to convince each other, but they are here to convince you. So please listen carefully to their position on the proposition and keep your questions coming. And if everyone is ready, if Castro is ready, he's the first to go. Castro, if you're ready, I'm going to start the time.
Okay, I'm good to go.
Can you share? Okay. If Castro is ready, the floor is yours. Take it and run. Your 5 minutes starts now.
Can you all see my screen? Okay.
Yes.
Good evening and welcome to everyone on this panel, the audience. And I would like to begin by saying that, first of all, the name life insurance is a wrong name that the industry has gone on with it for so long, because it's supposed to be income protection and not life insurance. If I die today and money is given to my family, they haven't replaced myself or my life. They've replaced the money I used to earn and run my home because I can't get up tomorrow to go to work. So if you see on the screen, you have a toaster that provides money every 1st and 15th. You need to insure it, because if that toaster breaks, you still need money. Then, as the panelists said, we have two kinds of life insurance. There are actually three. The first kind of insurance in Canada is mortgage life insurance. I won't get into that now. We could talk about that another day. But the institutions sell that, and people buy thinking they have life insurance. Then you have cash value, which is a combined product. Insurance combined with investment, and it comes in two forms: whole life and universal life. Then you have term life insurance. The issue with these combined products is that there are certain rules that are in these products that most of the people who sell them don't show the consumer, which is, like I've told the panel before on this forum, I was victimized myself and I took upon it to learn and empower others. If you look at this slide now, these are 4 rules embedded in a whole life insurance. But the people who sell will never show you this when they're selling, because if you know that you put 100 a month, some go for investment, some for insurance, and for the first 2 to 5 years you have 0, and then your money is locked in a 2 to 4% rate of return. You want to take money out, you borrow your own money, and when you happen to pass away, even if it was sold as a combined product, they keep the savings and pay the insurance. If anybody knows this upfront, nobody will ever buy. Unfortunately, they don't show people where they sell. These are copies of policies that I have that I can mail to all of you watching this Zoom. These are not illustrations. This is a guy who buys whole life insurance, putting $100 a month for 40 years. Let's make it simple to break down. 100 times 12 months is $1,200 a year. times 40 years is 48,000. If this guy dies, sorry, he gets 26,000. As you can see the circle below, you put 48 to get 26,300. I don't know how that is good for a consumer. Then if he wants to take his 26,000 out, he has to write a request. On a written request, London Life will make a loan on the security of the contract. If it was London Life's money, they will be borrowing him any amount he wants. But because he's borrowing his own money, he can only borrow on the security of that contract, which is that 26,000. Then life insurance again is for people who have others counting on them financially. Look at here. Equitable Life sells this to a 2-year-old child. I don't know where this child works, who counts on him financially for him to get a life insurance policy. And then they put the parents as beneficiary, but make them think they can take money out here to pay for the kids' tuition. Okay. Then look at what is in it. Do you think any parent knowing this line that's highlighted here will buy this product? For policies, let me just zoom so that you can see. For policies issued on a life insured under age 18, on the policy anniversary nearest their 18th birthday, we will classify them as smoker and premium will increase. That's it. I don't know. I don't think anybody knowingly will buy this. So when people were being educated on how to read these 4 funny banking rules in a whole life insurance, the industry came up with universal life and they changed those 4 words to those 4 rules to 2 words. Look at here. This guy put 170 for 28 years, 55,000 in. At 2015, his portfolio is showing 371. 55,000 in to get 371 to me is not a good product. This one has 1,300 in. If he wants to take it out, it has a surrender charge of 9,000. Bank of Montreal, 5,200, surrender charge 4,900. You can only take 356 out. Ivory, 1,400. Less surrender charge 1,300. Can only take 35 bucks out. So we teach people to buy term insurance and invest the difference. Never combine the 2 in one contract, because if you do, you just shot yourself in the leg. This guy was 24 years old, insured with a whole life product of 50,000, paying $90 a month to get 26,300. I can't see your screen, unfortunately, sir.
Yeah, time is up. 5 minutes.
Okay, that was a fast 5 minutes. Thank you.
Thank you. I would like to remind you that when we go to the question and answer section, debaters will have as much time to expand on whatever topic that they want to. And they can direct the question where they want to go. They can answer the question however they deem fit. Okay, let's go to Maggie. I don't know if you have anything to share, and you have the share button enabled on your screen. Are you ready, Maggie?
Yes, I am.
Okay, your 5 minutes starts now.
Okay, thank you so much for bringing us to this forum to throw light on this topic, is permanent life insurance a scam? And I thank the speakers for expanding what insurance is all about. For me, I work for an industry. I'm independent. Independent means that I represent so many companies. I'm a broker. It doesn't mean I'm broke. It means I have options. So my job is to shop the industry and find financial products for people who have specific needs and can afford. So life insurance is to protect your loved one's financial security in case of death. To say that permanent life insurance is a scam, I'm saying here that no, it's not a scam. As you can see on my screen, there are so many use for the different types of life insurance. Term insurance, you have the uses right there. You can look at it while I speak. Permanent insurance, there is also the need for permanent insurance. So term insurance cover term needs, permanent insurance cover permanent needs. So you can't stand here to tell me that permanent insurance is a scam because it has its needs. So permanent insurance is a superset of term insurance. All the needs that are being covered by term insurance, permanent insurance can do the same. But those that are covered by term, they cannot cover those for permanent. So they both of this insurance, they both have pro and cons. And I'm here to tell you that the cons of the term insurance does not make it a scam product. as well as the cons of a permanent insurance, is not or should not make permanent insurance a scam product. Yes, it's complicated. We know. The simple nature of an insurance contract is complicated, let alone adding an investment on an insurance product. Permanent life is being taught in a licensed program that is designed by Autorité de Marché Financier. This is designed. We all study it before we have a license. For a life license agent to come and stand here and say permanent life insurance is a scam, I just wonder how he got that and where that is coming from. The insurance company and the financial company is a highly regulated industry. The government cannot give you a license to a company to sell scam products or to an agent to sell scam products, because as far as I know, scam is fraud. So that is not happening. The government is there to regulate. And I want to quickly mention, even before my timer goes off, that there are different types of life insurance that have well mentioned by my colleague and even by the coordinators. They have 3 different types. The first one that the coordinator missed is a term 100. That one is not our issue now because it doesn't have cash value, because I think my opponent there is concerned with cash value and so on. So the universal life and the whole life, they are high-end insurance product, high-end designer insurance product that have amazing features, very attractive to those people who need it and who can afford it. So what am I getting at here? The very fact that a Toyota dealership does not have a Ferrari does not make Ferrari a scam. And if you work for an insurance company that doesn't offer permanent life insurance, it doesn't make permanent life insurance a scam either. So I would like everybody on this call to know that permanent life insurance is a very, very high-end designer product from the life insurance company for those who understand it because of its complicated nature. People know it, they have it, they are making use of it. Family use it to leave an inheritance. We all know that a good man, if you are a Christian, you know that a good man leaves an inheritance for his children's children. And if you do that, you are practicing what is good for your family. Families use it. Professionals, self-employed professionals, they use life insurance for their liquidity during retirement. Even corporations, they use life insurance to protect their companies from using their key person insurance. They protect their companies. They diversify their assets using the life insurance, and it is the cash value that gives them all that features that they enjoy. So I'm here to tell you and to tell everyone that permanent insurance has a place. It is not a scam. I raise my case. Moving on.
Thank you so much. That was perfect. You finished within your time. We are going to move to the second part of the conversation now, which is a rebuttal. So, Castro, since you went first, you are going to examine Maggie's position, examine what she said. You can ask questions if you want, and she can clarify. So when you're ready, you have 2 minutes. Again, I have this time.
I'm very ready. And typically, as people who sell cash value life insurance do, when I was I said it's typical for people who sell cash value life insurance to put an illustration sheet on a screen and talk. When I was talking, I was showing contracts that I've taken from people from all these companies. I didn't put a slide and just talk, because it's typical in the industry. They use illustration sheets to sell, and what they're saying in front of clients doesn't represent what comes in the contract. When we are analyzing contracts, we analyze what clients sign. We don't analyze what a representative said to a client at a kitchen table. That's to start with. Secondly, to say that the government regulates, you cannot go and sell scam products. If the government regulates everything, we both write the same exam, but at the same time, you have people or companies that are doing wrong. And that's why recently the government or the FRSA has been sanctioning these companies for ripping clients off. she did make a statement, which I like, that she actually used that statement, say permanent insurance has a place for people who can afford it, which is typical. When you tell people, oh, if you put 100 a month, you get 5 million at the end of the year, they go because they'll pay. And for anybody who owns life insurance, the representatives or the agents are paid based on how much you pay on your premiums. So if you can pay 1,000, they sell you permanent because they pay them high monthly. Term, which is the right product, will pay you low. Ferrari, Mercedes, Toyota, you go to a car dealer, if he's being paid by commission, he wants to sell you that Mercedes or a Ferrari to earn a high commission. And unfortunately, that's how the cash value life insurance sales agents do their work.
Okay, you done? So 1 minute and 40 seconds. That was pretty good. A good rebuttal. A lot in there. I'm sure we're going to expand on that more when the time permits. Maggie, you have 2 minutes to rebut Castro's position. Just wait a moment. I'm going to signal you when your 2 minutes starts.
Okay, can I share my screen?
Yes, please share your screen. Margaret, your 2 minutes starts now.
Okay, so thank you so much. From what my colleague said, Ebenezer, she said, most people don't show you the zero interest or the zero cash value. Most people don't show you. I think his problem here is about the agents. It's not about the product. The product has no problem. If you understand the product, if you know what the product is all about, you find value in the product and you can use it to your benefit. It doesn't make it a scam. From what he started saying, most people don't show you. The agents, they make more pay from more money. We are not talking about agents here. We're not talking about the pay. For the agents who don't do a good job for regulations, the regulators are on their back to fix themselves. I am an independent agent. If I don't do anything right, it doesn't make that product wrong. The product itself is the product, and it has its benefit. And you mentioned that the good insurance is the one that you can save and you save the difference. Here is an illustration for you. This is a 35-year-old man, $500,000. He's paying 47. And then at the renewal, they're going to pay 333. Here is a permanent insurance guy. Here's a permanent insurance guy who's paying 270, and at the end of the term for 25 years, the payments are all done. 500 insurance is sitting there, cash value is there, but investing the difference, 175,000 is sitting there. I assume a 7% interest for the difference, but there's no insurance. And it only takes discipline for somebody to save the difference up to 25 years without touching a dime, without doing anything. So at the end of the term, you are renewing for 333 a month at retirement. Who has that money to pay insurance? And that's all I have for you, just to say that permanent insurance has its ways. It is not a scam. It is a genuine product for people who like it.
Okay, time's up. Thank you, Margaret. I want to thank you and Castro for such an engaging debate so far. Thank you for sharing your wealth of knowledge. We are moving into the section of questions and answers. My co-host Asom is going to coordinate the questions. And audience, if you are willing to unmute and ask a question, you are more than welcome to. If you're uncomfortable in front of the camera, you can send your question through the message. And again, please be precise who you want to ask the questions, or who you want to answer the question, sorry. Yes, at this time, you can take as much time as you want to expand on a particular concept or to expand on the entire thing itself if you want to. You can use your time as much as you want. You can, direct the question wherever you deem fit. Asom, do we have any questions?
So we are going to start with Rose Joshua. I think she had her hand up for a while, so I think we'll start with her. I will unmute you and then you can pose your question. Okay?
Thank you, sir.
Okay, go ahead.
Thank you so much, everyone. Thanks for your presentation. I was very excited to learn about this debate, so I wasn't going to miss it for the world. And so I want to say a big thank you. My question is to Mr. Chwebefu. Okay. My husband had a life insurance policy back in 1992. And with term insurance, there's something called renewal. And when he was renewed 20 years later, the jump was too high because he went from 36 to 56 in 2012.
Yes.
And so because the price was too high, he canceled it. And based on my research, most people cancel at renewal for that very reason. So 4 years later, he died. And he died without life insurance. And the concept of invest the difference, unfortunately, didn't work because he did not. Sorry, I'm getting emotional. He did not invest the difference. So my question to you is, what do you tell families that you have covered for term insurance when the insured person cancels, no longer has a policy? In my case, he left 5 children with no life insurance. At some point, he had it, but if it was permanent, he would have had it when he died. But because it was term, he canceled. So what do you tell your clients when that happens? What do you tell their families?
First of all, sorry for the loss of your husband. Unfortunately, I don't know who sold him what. I cannot talk on something that I can't see in front of me to analyze. But if you let me pull up, enable me to share, bro. Let me pull up something so
at this point, sir, listen, I don't want you to pull up anything about permanent. I want you to address the issues
you asked
that
question,
deal with term.
You asked a question.
Because
now
you have a lot of clients.
Answer? I want to show you
good.
so that I answer your question.
Just focus on term, I beg you. Yeah.
Yeah, no, we are here. It's an important topic. And the coordinator said you can spend much time as you want to get your question answered. But if you want to rush me, I'm not going to engage in that because you've put me in a position where I have to clarify to you what you did or your husband did wrong. Again, sorry for your loss, but there is something called the theory of decreasing responsibility, which is what I want to show you and show you how buying term and investing the different beats permanent insurance, both with the insurance part of it and the investment. So permit me share here. Look, buy term, invest the difference. This is exactly what happened to you, which this reflects back to the slide that Madam Margaret showed before. If the theory of decreasing responsibility and buying term and investing the differences, this is a 24-year-old who bought that insurance for whole life of $50,000, paying $90 a month to retire at age 65 with $26,300. If he died prior to 65, his wife and kids get that $50,000 he was insured for. If he lives to age 65, he gets $26,300. That same $90 he was spending, if he bought term, even at age 27, term for $250, he only pays $40 a month because term insurance gives you the maximum face amount for very little. Then you take that difference, which is the $50 he was spending plus his 40, which made 90 for 50,000 of insurance. Invest at a moderate 6% rate of return. That's 106,000 at age 65 versus 26,300. At 12%, which many people don't think 12% exists out there, that's 600,000. That is why buying term and investing the difference beats cash value because life insurance was never meant to be an investment. Speaking about renewal, every product that is renewal, but if you practice the theory of decreasing responsibility, if you buy insurance today at 25, you buy a house today for 500,000, your amortization is at least 20 to 25 years. If you have a 1-year-old child, in 25 years, that child will be 25, left university, moved out of your house. Your mortgage has been paid off. If at 25 years after, you don't have any child counting on you financially, you don't have any mortgage, and that difference that you invested has accumulated, you are self-insured. you don't need to renew life insurance. We are the only life insurance company that teaches people to get out of life insurance, because life insurance was not meant to be a permanent need. Life insurance is meant to be a temporary need. When you have all these people counting on you financially and you haven't accumulated those hundreds of thousands, you protect that in case that unfortunate thing happens, you have money. Life insurance is to buy wealth when you don't have wealth until you accumulate wealth. It's but normal that when you are renewing a life insurance policy, the premiums go up because you've aged. But if you have money in your account, no mortgage, no kid counting on you, what's the need renewing? If you buy a car today and drive till you are 100 without crashing that car, you don't get a check from the insurer. But if you sell the car, you stop paying insurance premium for the car. Thank you.
So are you saying that my husband's not renewing his policy was okay when he had
No.
5 children
That's not what I
who
said.
went to university? That's what you just said. You
No,
just
I
said that
said
there's no
I-
need to renew,
That's
but he
not what I
had
said.
children. Okay,
That's not
what
what
you
I
said.
said.
Okay,
I
I'm happy
said-
this is being recorded.
Yes,
Can
I'm
you,
happy.
can you clarify?
yes. I said if you buy, let's say you buy a term 25 today, right? You have a 1-year-old child. You just bought a house today. Amortization will take 25 years to pay off that house. That 1-year-old will be 25 years, finishing university, moving out of your house. You've accumulated wealth. Why on earth should you renew your policy when you have hundreds of thousands in your account, no kid counting on you financially, no mortgage? I didn't say.
So you're making some you're making some very interesting assumptions here, because so you are talking because you are not in my shoes, all right? Because here's the thing, and that's exactly what happened, in the sense that when my husband bought the policy in 1992, he had 1 child, and then later we got 4 more children, so he had 5 children. 20 years later, his oldest child is only 20. He has not graduated from university. The other children are 18, 16, 14, whatever. They have not graduated from university. So you're saying that he didn't need to renew, whereas he has responsibilities that still need to be taken care of. And these are kids who will take student loan, and their father died, and they had student loans, and who's going to take them through university? Who's going to pay all that? So you're saying basically that, because he had this term, and you're making assumptions that he's accumulated wealth. How does a man accumulate wealth when he's raising children at the same time? So you're not talking very practically in this situation. Like, I'm telling you my own story. So how do you address that? You're going back to that. You're going back to the permanent. I'm telling you to talk to me about term.
No, I think you are part of this industry. The way you are trying to push me, it looks like you have links with those industries, not because of just the fact that your husband died. I am showing you a contract and how it works. You are telling me not to. Let's say your husband, let's say he owned this policy and put in 48,000 to die and get 26. How would that have helped those 5 children?
Okay, wait.
Can you hold on for a minute? I think the question that was asked is a little, it's specific to a specific situation.
Yes.
Mr. Ebenezer does not know what the contract was specifically. He can only speak in general terms. He cannot go into real specifics about this particular situation. That is why I think he's speaking generally. He probably would need to see, the contracts and what other information that was part of that sale. So I think it makes it a little difficult for him to give us really specific answers that might touch on the specific question that has been asked. I think that is why we get the generalities that he's putting out there. But I think what I wanted to ask a follow-up question, Mr. Ebenezer, is we talk about, getting a life, getting a term, and then investing the difference. But now there is a certain level of discipline to invest, right? And I think that's why most people get the life, and then they don't have the discipline or don't have the means to make extra investments. And then at the end of the day,
correct,
they don't have the investments. They don't have the 100 and 200,000 that we assume that they would invest and get in place. I think the question I would ask is, how do you get your clients? How do you encourage them to invest? How do you plan that investment with them? Because again, they get the term, that's fine. Now, investing now is something that they have to do on their own, maybe without the agent, right? So how do you encourage your clients to get the discipline and the commitment to make the extra investment that is needed?
Thank you very much. That's a very great question. Any financial planner who sells life insurance to his or her client and not put them on track for investment is a clown, because you cannot expect a client just to go around investing. It's not their job. They don't know what to do. What we do, we run a financial needs analysis for a client, because people are juggling with money. Paychecks don't come with instructions. Just like kids don't come with instructions how to bring them up. You do a financial planning for your client. You run a financial needs analysis, which is like a financial GPS. You show them where they are, then you show them what to do to get where they want to reach financially. If you jump into your car here and you're going to Phoenix, Arizona, and you don't put an address on the GPS, you might end up in California. So when you put that insurance in place based on the information the client has given you, which is confidential, customized, based on what they're earning, based on the rate of returns they can get, you say, okay, this is what you need to do to get where you want to arrive financially. If you just go and sell a life insurance and then tell a client, go and invest, where? You haven't helped that client. So the discipline in combining the product in the cash value life insurance makes people think it's there. But again, if I put in 100,000 to get 40 at the end or at retirement, was I insured? No, they just refund a part of overcharged premium to me. They refunded a part of my money to me. They didn't give me any money. I didn't get any free money. If that answers your question. So you put a plan in place, you put the income protection in place, you open TFSA, RSP, which most of these cash value life insurance say to people that that's the way to hide taxes. There's no way you can hide paying taxes in this country. You can defer taxes, pay your fair share of taxes, defer taxes, and pay your own share instead of saying you're hiding. Because I'll give you a good example here. I just replaced one policy that the clients were told a whole life that they can take money out there and pay for kids' education and all whatnot. Okay, the government gives Canada's education savings grants to kids to study. When you go and lock that thing in a life insurance policy, which is not an investment, how do you get that Canada's education savings grant from the government, which the government gives up to a maximum of $7,200 per child? You just devastated that family financially by making them believe that cash value is where to hide taxes. But when it comes time now to take money out to pay for that kid's tuition, you get hit with a surrender charge. If you want to take money out to buy your first home, which you have the right to take it out of your RRSP, or if you want to take money there to go to school, which is called lifelong learning program, and you can take money out of an RSP without being penalized, you are dinged with a surrender charge. How is that helpful to a client? That's why I call it a scam. Because if you buy two pair of shoes and you get home and they are all left-footed or right-footed, you bought one shoe, you didn't buy a pair. With whole life insurance, 1 plus 1 is 1. You're paying for investment and insurance. You die, they pay the first amount, they keep the savings, which is in the contract. Universal life is 1 plus 1 is 0, because there is something called cost of insurance. We keep talking about how it's beneficial to people, but we don't show people what is in there. And it's very easy. I just drew this before we came online. Let me break it down to you here for a minute. Universal life insurance is like a leaking bucket. On the left-hand side, you have insurance. The right-hand side, you have your investment. But they tell you that you will be paying 100. Let me make it 100 easy to understand. You pay 100 every month. Your premiums will never go up, which clients believe because you see the 100 leaving your account every day. In this scenario, the first few years you're young, cost of insurance is $25, $75 goes to your investment. A few years go by now, cost of insurance is now $50, That 100 from your account, 50 goes to your investment, 50 goes to the insurance. Few years run by again, the cost of insurance now is 75. You are still seeing 100 leaving your account. Now 25 goes to the investment. When the cost of insurance is $100, now they take the 100 from your account, it pays for the insurance. What goes to the investment? Nothing. That's when it starts imploding. When cost of insurance is 125, they take the 100 from your account, they go now to your investment and start draining it. They top the 25. When it's 150, they drain. When it's 175, they take the 100 from your account, and then now you have $0 in the investment, and that's where the policy lapses. When you're talking about renewing, that people are canceling because when they want to renew, the premiums go up. With permanent insurance, this is where then it lapses. They don't have no insurance, no investment, because now cost of insurance has become $200, and now they can only take 100 from your account, and there's nothing in the cash value. They mail you this letter that you can see here from Sun Life. It has come to our attention that the above universal life policy is currently being underfunded. Why? Because now the cost of insurance is 200. They can only take 100 from your account, and they have nothing to drain to top up the premium. This means that the premium you are paying is not sufficient for the cost of insurance, and it's incumbent upon you to call and let them know we require a decision by you as how you would like to continue paying for this policy as soon as possible. That is where it lapses, which is why universal life 1 + 1 is 0, not
I
even
think
2. Because when it lapses there, you have no insurance, you have no investment.
I
And they always slot two. Can I finish, please? They always slot two things in this policy. YRT. Anybody in this forum who has a universal life insurance, I go open it, search, you see YRT or ART, which means the same thing. YRT means yearly renewable term, which is why that cost of insurance is going up, or annual renewable term. But they will never show this or the point of sale, because the client will say, why is the cost going up every year? Because if they show, nobody will sign. But that is where it lapses.
Thank you very much for responding to that question. If you don't mind ending the share screen, Castro. Thank
Sure.
you. And then I think it's fair to give Margaret the opportunity to speak to what Castro has said, or to the question specifically.
Okay. So my with all due respect, Mr. Castro, I'm surprised that you think that life insurance is a scam and you don't know much about the product, and you are actually presenting the product. So those figures you have been showing, the figures for the 50,000 and the 26,000, I don't know where you got them from. I don't know where those contracts are coming. It doesn't resemble like
from clients, and I can mail them to you.
Don't worry. I don't need you to mail them to me. I do life insurance. My family have all the life insurance. They have everything you just mentioned. You said there's an annual renewable term or yearly renewable term. All insurance, including term insurance, are annual and yearly renewable. That is why if somebody's term is expired and they want to renew...
That's false. Term is not yearly renewable. That's false.
Let me tell you, it is. You know the meaning of yearly renewable. Yearly renewable just means
English. Yearly
it just means that it just means that as you age one more year, your insurance premium increases. That's the meaning of yearly renewable term. Every year you are getting older, the insurance company charge you more. Even on term insurance, it is a practice. That is why when somebody is 25 and they get to 50 or 60 and they want to renew that same insurance they got, it's no longer $40 that they were paying, it's now 300 and something. It is because of the age. That is the meaning of yearly renewable term. As you age, the insurance tax you as you age. So it is all done. You said the universal life is going to lapse because of high premiums. I agree with you, but the cash value in the life insurance, with all due presentations, it's a complicated product. They have to design it in a way that every cash value that is in there is an engine for the life insurance. So the cash value takes time to compound, and if it compounds and gets to a certain level, that is why the investment is there. The investment is there to compound it, get enough money to fund the policy to the end of life. And so if you or somebody with those ones that you were illustrating, I don't know where they're coming from, if there was time, I will illustrate my own figures. I have tons of companies that I represent. There's Universal Life, there is Whole Life. All of this, Universal Life is the medium, Whole Life is the high-end product. They have good features that people use. I'm telling you, corporations use them for diversification of their stock, for protection of their business, using the key person insurance. Even self-employed, listen to me, self-employed medical doctors, lawyers, they use it as a liquidity for their retirement. And it is that cash value component. If that cash value that they put in, I'm telling you, this is a product for people who can afford, and they use the futures very well. If anyone on this call does not understand life insurance or does not understand permanent life insurance, and you don't know how it works and you cannot afford it, I will advise you to stay away from it. But it is not a scam. Please, it is not a scam. That's the emphasis on this call. People
Can I ask you a question?
Yes, come on.
Okay, there are two words that you've used continuously. It's
Yes.
sad to see that people are being ripped off like that. That people, doctors are buying this stuff. And then there's the word if. Do you know that if is a very bad word to be in a contract?
What the if is? You said the insurance will lapse. The insurance is not lapsing.
And when the panel started this, they said this product should be simplified so that people can understand. You've used the word complicated now 4 times. Why on earth should a product be complicated for somebody who is paying a monthly premium? Why can that person not just flip his product and see straight forward? I bought.
Do you want me to answer that question?
Let me finish my question. Why is it complicated? The answer is simple. Because the more a product is complicated, the more the client is confused and the more the client is abused. And to say that Universal Life is a high-end product, it's true. That is high-end. It's a Cadillac for those that are selling it because it works for them and not for the client. I have mine. You say you don't know where I'm coming from. I can send mine to you with my name on from a company you know. And then I highlight everything I just told you, and you tell me how that on earth would have helped me. The only way to benefit from Universal Life Insurance is if you die in the early ages because it will implode. While that cost of insurance eats the investment, it implodes. Saying that term life insurance has a yearly renewable, that's not true. If I sell a 35-year term life insurance, if your premium is $10, you're paying $10 for 35 years. You're not paying $10 for the first year and $15 for the second year. That's why term you pay the same thing. But then if you practice the theory of decreasing responsibility, everybody knows when you're getting old, you're getting closer to dying, which is normal that when you are about to renew, the premiums go up. Why renew if you've accumulated money? You can put money in a shoe under your bed.
Why does the premium go up when you renew?
Can we have Margaret answer the question? I think
yes.
Can you answer, Margaret?
Yes, he said they don't. I just want to clarify that the insurance is yearly renewable. That is why if a term insurance expires and you go to renew, the price goes on the roof. If you sell a term insurance block for 20 years, somebody is paying $10. That $10 has been calculated from year 1 to year 20. All of it has been included. It's the same with a permanent insurance. If I say you're paying $270 for your permanent insurance, you're going to pay it over a period of 30 years. Stop there. All the investments will accumulate, compound, and the policy will auto-run itself to the end of life. So
that's not true, Margaret.
I
just wish
I'm not here to say
people in this forum.
I am not
here.
People
in here. I just wish they could be honest to tell you. I own those products and they don't work the way you're explaining.
Excuse me, you own those products. You said you have been scammed. I was going to ask you how were you scammed? So I own the product as well. My generation is covered 2 years down. I own the product. It's not a scam. I can afford it, people can afford it, and they are using it. When you say it's a scam, it has zero life insurance value. When they design a product, there is a manufacturer's guide, there is a direction for use, there is a warning for the product. And let me tell you, if you are looking for the cash value that is zero in the first 2, 3, 4, 5 years, go to agriculture. If you plant a mango tree, it doesn't take 1 day, 2 days, 5 years to grow. And
It's
by the
one
time
seed,
it grows,
and it's only one seed, though.
it is
You plant
producing
groundnuts or
fruits.
corn, some will die, some will germinate.
Yes, so let me tell you that
Right term invest the
term
difference.
insurance you are asking about, zero life, you should, the agent should explain to you what it is all about, tell you the features. There are normally pro and cons of each product. If it's
Unfortunately,
a
they don't do
manufacturer, we
mileage.
use a manufacturer's guide and everything that you need to do. We are
Unfortunately, they
here
don't
to
do, and you
advise.
and I know pretty well. They don't do that.
Yes.
Because if they do, nobody will sign up front. Would
No,
you
me,
go to
I
your
have
bank?
it, I sign it. So
Would you go
it's
to your
not
bank?
like
Let me ask you
nobody.
an honest question.
Wait,
If
before
you
you
go to
ask
your
me,
bank,
let me answer your question first. There was a
Okay.
question you talk about. You need to control your people to save and make sure that they discipline themselves in savings.
no, you
We
don't
all do
control
that.
adults. You don't control adults. I say you put
So
the
you say
product
you put
in
them
place.
in track. Yes, we
Yes.
always put them in track. We always ask them to do. But if they turn around tomorrow and they don't do it, how is it you that did not put? So
Whose fault is that?
people go into their accounts from time and again to take money to do transactions. They don't leave it there. They don't come and ask you before they take the money.
Whose
So
fault is that?
that's what the question came, that how, if there's any way, which what can you advise? So I just showed a slide here that shows that if you invest the difference, at the end of the day, you will see which one is better. And that is the options we give to people to choose. I'm here to say that the options, they are there, they are available. I am not against term insurance. Term insurance is great. It covers temporary needs, and permanent insurance covers permanent needs. So if you only have a term insurance, your permanent needs are not covered. They use term insurance to, okay, time.
Thank you, Margaret. We have a question, a hypothetical question here.
Excuse me, before you finish reading the questions, if anyone is on the call, I will advise them to scroll over their phone and get a tool from the Ontario Securities called Compound Interest Calculator. Get smarter with your money. Can everybody pull that tool up? We'll all do the scenario here that this lady is requesting. So everybody, Compound Interest Calculator, get smart about your money. Pull it up.
Is Gutierrez, is he in?
Okay. Yeah, Gautier is here, and Gautier is a man, sorry.
Oh, sorry. Could you explain the scenario so we have debaters understand directly from you?
Yeah, I'll be very delighted to do that. Thank you very much for putting this platform together, and thank you for the presenters tonight. So my scenario is I'm 30 years old. I'm a full-time employee, and I decide I have two options on the table. So my first option is to go for a permanent life insurance, $250 that I pay monthly. And I'm planning to retire early, so 55 is my target. So 25 years term, that is what I'm looking at. Option A. Now, option B that I have on the table, I need to make a decision, is signing up for a term life insurance at $150 that I pay monthly. And the balance of my $250, I'm putting it into an investment account for 25 years, assuming a flat interest rate of 5%. So the two debaters can take time to make calculation and tell me, after 25 years, what am I expecting in my balance sheet, or after putting those 250 in the two different scenarios.
Okay, I have a suggestion. I have a slide that represents exactly this scenario. Can I show the slide, Gutierrez, and see if it can answer your question?
I get a feeling Margaret got the question. Castro, did you get the question clearly?
Yeah, I did.
Perfect. Okay. So I think, Margaret, you want to go first?
Yes, I want to share the slide that depicts that that question
Okay.
or that scenario. So
Go
let
ahead.
me share that slide, and Gute will be the one to just tell us if this slide is depicting what he wants to know. So this is let's say you are 35 years. Let's assume that's a term insurance. Let me get my pen. This is a 25-year term insurance of 500,000. You're paying 47,000. Okay. After 25 years, insurance is done. You have to renew, and you renew at 333. So, but with the term permanent insurance that you sign up for the same amount, you have $2,270 as your premiums. So at the end of 25 years, your cash value will be 174, and you still have a life insurance here. There's no more need to renew at this point. No need to renew. So if you decide to invest the difference with this same scenario, pay this $47 for this 500,000 and invest 223. I'm generous with the percentage, 7% for the next 25 years. Using the compound interest calculator I just talked to you about, getting smart about your money from the Securities of Ontario, you're going to have 175,000 in your bank account. If you stay disciplined, never touch a dime, continuously putting in the money for 25 years, you end up with 175,000 and no insurance. So does this resemble what you were thinking about this scenario?
Yeah, I'm looking through the data. Just give me a couple of minutes to process it.
Okay.
You would really have to be quick. We don't have too much time to wait. So I would give you a minute to take a look and then make your comments, and then we'll move on to Castro.
Okay,
If you do need some explanation, just ask your question. Don't be shy.
No, the 35 makes sense. The term 25, the first line, makes sense to the premium. We have it 47 there. I just need to quickly do like a quick look at the last line. So Castro, go ahead, and I can come back later on.
No, the last line just says that you are investing the difference, and the difference between 47 and 270 is 223. You are investing 223 at 7% for 25 years, non-stop. Never touch the money. It's going to compound to 175 at the end of 25 years. And that's what you go to your bank account, you'll find 175 in your bank account, but then the insurance is expired, it's gone. You don't have any insurance anymore. So that's the scenario I thought you were asking about.
Yeah, the scenario is correct. So yeah.
Okay.
So we'll move on to Castro. Castro, any comments or make your comments?
I will not pull up any slide regarding that. It's a straightforward thing. Any investor who tells you you will get this amount after this year, who knows what the markets will do tomorrow? Nobody. Even Fortune 500 doesn't know what the market will do tomorrow. When you are talking genuinely to somebody, you are saying you will have about this, between this to that, not you will have this, because you don't know. Secondly, people use fear mongering about this renewal issue to deter people from buying term insurance. Oh, if you buy term insurance, you want to renew, premiums go up. What I typically see in the industry is, if they were genuine, they'll be selling straight term product. Every term product I've seen, and I've replaced them. And before I replace, I run figures, because figures don't lie. I show the client. They will sell a term 10, and then they put something RSC, and they will put it in an abbreviation. They then put it in full, because the client again, that RSC simply means renewable and convertible. So when that term 10 is expiring, they renew it and convert it to permanent life insurance. Why can't we not just do something that's right from the onset? That is why I'm coming back to that word that is complicated, because the more they complicate clients, the more they abuse clients. If you want to sell a term, sell a term. If you want to sell permanent, but inform all the gotchas that are hidden in the policies. Don't sell a term 10 to a 10-year-old guy, and then when it's up, you renew and convert to permanent. Back to Gutierrez's question, the beauty about buying term and investing, the difference is that if you die too young, there's money, the insurance covers. If you live, God blesses you with a long life, you got money. Permanent life insurance is a document. You're paying money, paying money, paying money. You cannot cut off a page to order pizza. Meanwhile, with buying term invest the difference. You want your money, you request a withdrawal. It's given to you. With universal life, you request a withdrawal, you are hit with a surrender charge. I still want somebody to explain to me how that is helpful. That I want 1,000, I need to surrender 9,000 to get 1,300. How is that? How does that make sense? If you go to your bank, put in your debit card, punch your PIN, and you say you want $500, and the message pops on the ATM, hey, Mr. Ghana, take this $500, but when you're bringing it back, bring $750. Will you not want to talk to that bank manager and find out what's going on? But because people are not comfortable talking about death or dying, they're deceiving them with these things in life insurance contracts. Life insurance was never meant to be an investment, and that's why it doesn't work. I wanted to buy my house. I requested money from my universal life insurance, and I was told that I had no money because the surrender charge surpassed what I had in there. How is that a comfortable or high-end product? I still can't understand.
Okay, so let me answer. I'll start by the word that you always use, complicated. By nature, all insurance contracts are complicated, whether term insurance or permanent insurance. So, but the simple fact that you are adding an investment component in a insurance contract, it means that you should be able to explain detailedly and tell the client what are the features that are attractive, or what are the features that those products present. And you saying that you can go to their bank account and request money and take some money out to do whatever you want to do means that even the discipline for the 25 years will not be maintained. So at the end of the contract, that family will not have enough money in that account as it was supposed to be. So then that is an issue right there. Again, you talk about we wanting to withdraw money from your cash surrender value or whatever, and they told you had no money. Did you follow the manual? Did you follow the direction of use of your contract? The contract says, if you know it, the first 10 years of your contract, there is no cash value there for you to take out.
That's why it's robbery.
Cash value
That's
is
why it's
building
robbery.
up. It takes time.
You
It's
cannot
not
put money in your
robbery.
bank account, you go, you don't get it. That's robbery.
It's not robbery. It takes time for the money to compound to get to the point where you can take it out. It's the
What
same.
about the book value? What about the book value? What
the book value is there. The book value is there. If you want me, I did not plan to bring my illustrations to this table, but I encourage everyone on the call, if you want to know what it is, you can contact me. I will show you what I have to show you. I tell you all the pros and all the cons of any type of insurance. I do sell life insurance. I sell term, I sell permanent. I deal with all the two. So there is no one that I'm not familiar with. I'm familiar with all of them. And
I have a question for you, Margaret.
Yes.
Who do you sell term to and who do you sell permanent life insurance to?
Okay. People who have needs just for temporary needs. If somebody said, I just want to, this mortgage is the headache that I have. I just want to cover my mortgage. I'm fine. My cash flow is low. Low cash flow customers that need just to cover their mortgage, I give them term insurance because that's what's going to help them for.
So if
there are some court order child support. There are some court order spousal support that they need insurance for, and that is a term insurance. If you need to pay child support, you pay child support maybe up to age 25 if they go to school. So I sell term insurance for that purpose. Those are the clients for term insurance.
How does term insurance pay child support when child support is paid on a monthly basis? But
they say that you should take. They say the court orders a child support insurance to say that take an insurance in case you pass away. That insurance can support that child. Because the simple fact that I'm 5 years as a child and my father was paying child support and he died, I'm still 7 years, it doesn't mean that I'll not grow up. So that insurance will come to pay the support for that child until that child grows up. So I select my clients, I look at the needs of my clients, and then I give them the insurance that it's okay for them in terms of their availability, of their affordability, and in terms of their needs. So those are the clients I said term insurance for.
Thank you. Considering that premiums for permanent life insurance are very high,
yes,
how do you manage a situation where somebody has a mortgage for 600,000, he has 2 kids below 10, and then you're selling him a permanent life insurance for 100,000, which you'll be paying more than $100.
Okay.
If something,
thank you for that question.
My question now.
Okay.
If something were to happen to him, if at all you're going to pay that 100,000, what would that 100,000 do to a widow with 2 kids below 10 and a mortgage of 600,000?
Okay. Thank you so much for that question.
Margaret, while you take a second to think about the question, Marflo is the next I would call up once Margaret is done. So Marflo,
okay.
hold on.
Okay, let me just answer it before I forget. Thank you very much for that question, Castro. I see those cases on the field every day. So if I see somebody stand in front of me with all the needs that they have, I analyze it. I sell both term and permanent insurance. If there's somebody asking me, oh, I need term insurance for my house, for my kids, it's 700,000, fine. And I will ask their permanent needs. Do you need insurance for final expenses? Do you need insurance for this or for that? After they say yes, I give them a combination of term and permanent. And that would match their cash flow that they have in front of me. So I do that a lot. I have clients that they have both permanent and term needs together. So for their needs, I can layer their insurance and it covers exactly what they need. So that's the answer.
Just a quick follow-up. Most of people here live paycheck to paycheck. When you provide them the options of getting 2 insurance policies in that, do you consider how much money they're bringing in, how much money they're bringing in a month, and how much money they're paying for insurance and everything else? Do you take that into consideration before you suggest 2 policies for a family who might be struggling?
Thank you. It's not a 2 policy, it's 2 in 1. The layers, that's why I said I layer them. There is one policy that is permanent, maybe for 50,000 permanent, because that's the cost of final expense. I put it in there, and I put the rest is term insurance. So together, they're going to pay a premium that is equal to what they can afford in their budgets. I give them scenarios about 1, 2, 3, 4 to pick from, and they say, I pick this one. And all of those scenarios carry their needs. So I do serve all of the clients. I serve term needs clients. I serve permanent needs clients. So it's all depending on their needs and their affordability. That's what I can tell you.
Okay,
and the permanent insurance, they have beautiful features that I explained before that people use it. The beautiful features are they can take a premium break. If something is really hard on them, if they're changing jobs or something new is happening in their life, they are okay to take a premium break, and they have their cash surrender value to sustain the cost of insurance in that policy until such a time where they can come back and resume payment. That's why that product offers a lot of flexibility. I have done so many times with my clients who are buying their houses. Yes.
Castro, you would have 1 minute so that we can move on.
She made a very valid point, which is still detrimental to the client. If the client is financially hard up, you give them a premium loan. And premium loan is the money they've accumulated in the cash value. What if that premium vacation, what if that cash value gets drained, or everything has drained and the client has not gotten back up on their feet to carry on with the premium? What happens to the policy?
That's why it's called a premium break. It's not a premium loan. It's a premium
Yeah,
break.
premium break, whatever
Take a
you call
break.
it.
If you want to take a break, they know that is a feature of the policy that the clients know before they go in. They say that if you have a break, you need to come back at this time, because after this time, this is what is going to happen with your policy. And they agree to it, and they come with it knowing that that feature is available for them to access. It's not like if forever take a break and then tomorrow there's no insurance. No,
Okay.
those are
Thank
the
you.
things we explain to them from the beginning.
Thank you very much. We would like the question to be very brief. If you can, please put your question in a sentence or two. And guests, please, let's try to summarize. Okay, we're running almost an hour and 20 minutes. Asang, do you want to bring?
I think Madam Florence Songbi.
Thank you. I've listened to both people. It's been really wonderful, very educative. One thing I've learned, insurance has always been complicated. If we were to say, I can say that I've listened to both are still scam, if I can call it a scam. Yeah. But one question goes to Maggie though. She showed us a board where at the end of 61 years, somebody renews the insurance at a higher premium at 333. And then for the permanent one, there is no insurance. It's zero. Don't you think the person could still renew? If that person was still renewed, so the permanent is all.
No, I'm saying that there's no renewal with a permanent. That's why the zero is there. There's no renewal, but the insurance is ongoing.
Yeah, but no, the insurance. Okay, so if the person died, they're still going to pay the premium out. They're still going to pay the amount.
Yes,
50,000, for example. Okay.
No. Yes, if it's 50,000 that was contracted, they'll pay out. Because
but
you are only paying the premium for such a limited period of time, and then you stop the payments right there, and the cash value keeps on compounding because it is the engine of that policy, compounds and auto run your policy to the end of life. Whatever the end of life is, if it's 120 years, it's going to go for 120 years.
Okay. I will want to give an example, and this one concerns me.
Okay.
Because I took a life insurance. It was universal life, the one you call permanent. And where the person who gave it to me looked at it and said, okay, you are going to be paying this amount. I think I pay more than $200. And the person said, at the end of my term, I'm going to have 20,000 cash.
Yes.
8 years after I met with a policy, one of the policy, can I call it policy owner?
Agent.
One of the people, agent. And I said, okay. Right now, and true to it was because of this argument on this forum. I said, can I look at my situation right now? Can I see how much money for the past 8 years I have compounded from my savings? Do you know what was there? Less than $1,000. And I asked the person, so with less than $1,000 in 8 years, where is that 20,000 going to come from? Say even in 30, 50 years. And the person turns back and says, oh, okay, I'll go and look at that policy. Who was the person that signed to this policy?
Margaret,
may I ask, is it a whole life or a universal life?
She said universal.
I think she said universal. I think she probably fell off the call.
Okay.
I think she's gone. Margaret, with the limited information you have, I'm sorry, she cannot expand more on the situation. Can you answer?
Yes, with the limited information is that before 10 years into the policy, there is no cash value that is available for somebody to take out. So after 10 years of the policy, for sure, the cash value is available for you to take. It is right there. You can access it. You can do whatever you want to do with it. So because she said it was 8 years, it's possible that there's no cash value there at age, but after 10 years, then that's when you are available, the cash value is available for you to take out, and surrender charges are all gone after 10 years.
So I think what she said in the question was that she had accumulated about 1,000 something, and it was,
what is that?
She was already 8 years into the 10 years.
Yes.
So her question was, at what point does it get to 20? Because if after 8 is just 1,000, so if you do 1,000 every 8 years, she's definitely going to die and not never get up to the 20,000 that was I don't know if they said that was promised or that she was talked about, right? I think there's a little bit of that too.
Yeah, what I'm saying is before 10 years into the policy, there is surrender charges. And if that could be where the cash value is only at 1,000, but after that, all the money from the fund account becomes the cash value at this time. I have those policies. I monitor my investments. They are going well.
Can I
So
ask a question?
sometimes it just depends on how the policy was set up. I can't vouch for it.
Mhm.
So
Again, like we said, with the limited
again,
information, we know the
Yeah.
information was
Yeah.
limited.
Right.
Castro, I think you have...
Castro, chip in 30 seconds, then we'll move on.
Yeah. Again, Margaret had been saying before that she explains everything to
yes,
clients, right? But she just said a second ago that it depends how the policy is structured. I just want Margaret to know that she sells policies for companies that are designed by the companies and but not her. And she even said 5 minutes ago that she can send her illustration sheets out. My sister, illustration sheets are illustration sheets, contracts are contracts. When we are analyzing a policy, we are analyzing what the client signed and not what the agent told verbally, which is why anybody who owns cash value should never call the agent that sold it to them, because most of these companies teach and license their agents without showing them this hidden rule. I started this thing with a Sun Life. I never knew until they told me, go get a license and come, we'll put you on track. I said, well, why would they let another company license me to put me on track? I started digging deep. They don't show you those hidden rules on a whole life. They don't show those hidden rules when they're training their agents on a universal life. Most of the people are trying to help people. I don't know about you personally, but most people are trying to help people, but they are taking advantage of people because their companies didn't show them these rules. And it's sad. So if you want to get the truth about a whole life or universal life policy, you're calling the company, not the agent.
Thank you very much.
I've been waiting for you guys to ask, where does the money go for these 10 years that they are talking surrender, surrender, surrender? It's simple. The agent is paid with your money. When you're paying your premium, the company is collecting that money that they paid the agent with, which is why clients are getting 5 and 10 years of zero. If life insurance was an investment, why would your TFSA not have surrender charges too? Why would your RSP not have surrender charges? You put money in a TFSA, you can take it out the next month. But why is it that in a life insurance you have to have surrender charges? Because the agent...
Thank you very much, Castro. Thank you very much. Thank you, Margaret, too. We are going to move on. We have, first of all, a statement from Emmanuel. I'm going to read that, then he has a question to follow up. This is from Emmanuel. Just an experience. I'm impressed with Primerica. My wife, who's a student, bought a term policy for $500,000. But Primerica came back and said, given your status as a full-time student, you can only buy term policy worth $300,000. And a check to my wife with a refund of extra premium deducted. I mean, insurance company refunding a client. I was impressed by that. That's from Emmanuel. That's the first part. Then here comes his question. How do you reconcile the significantly higher premiums associated with permanent life insurance with the potentially more cost-effective alternatives like term insurance for those primarily seeking protection and investment options for those seeking wealth accumulation? Margaret question. I think he means the question is for you, Margaret. I don't know if you want me to repeat the question again because it was a little bit unclear. So I'll repeat again. How do you reconcile the significantly higher premiums associated with permanent life insurance with the potentially more cost-effective alternatives like term life insurance for those primarily seeking protection and investment options? And he says for those seeking wealth accumulation. I didn't completely understand the question, but whatever you understand and however you interpret that, please go ahead.
Yeah, so if you have a permanent insurance, for sure, you're going to pay more premiums for it. And if you want to seek like building wealth with a permanent insurance, it is a cash value in that permanent insurance that will provide the engine for your permanent insurance to run till the end. And when it runs till the end, if your end is 100 years, that wealth is going to transfer to your family tax-free. That's the wealth building nature of a whole life insurance or a universal life insurance. So if you want to build wealth, the insurance you have to get is the permanent one, not the term. So, but if you want to go just for term, then you're going to be using investments out of the insurance. You don't have to be in insurance. Use the investment out of the insurance and invest it however you want. It can be ETFs, it can be just tax-free savings investments. That's fine. So that's another wealth building. You build wealth through investment using the compound interest and the rule of 72. If you have known the rule of 72 for investments, if you can get higher and higher rates of return, then you are able to build some wealth and beat inflation and beat every other tax advantage investment vehicles. So that's my answer to that question. If you want to build investment, you want to build wealth in the investment world, then the rule of 72 is your best bet. Invest in whatever investment vehicle you need. But building generational wealth is a permanent life insurance that transfer to your family tax-free.
Okay, thank you very much for that. We just have comments on the chat, and I'm going to read them quickly. So I think this was response by Joshua. After 25 years, you have about 60K cash and no life insurance with option B. On the other hand, with option A, you have a permanent policy, 500K policy that covers you for life. Your family will not be like mine because when you pass, they will have 500K. Okay. Rose continues again with comment. Guys, think about it. Think. Cheap is not always the best. My family is a living experience. My husband took a shortcut and my family lost 500K because at renewal, he canceled and he was raising kids. So not enough savings. Think, do the math. She goes on again. Investing the difference does not replace the insurance. Eben, and I think she means Castro. Think. No one knows the market, yet you are telling people to give up on permanent insurance and still depend on the market you say is not reliable. Now you're saying we should convert to permanent. At what cost?
I said that.
Comment again from you. Do you want to?
I think Castro deserves to respond to that.
Yeah, please.
My analysis is the cash value people, when they sell term, they put renewable and convertible to convert it to permanent. We strictly sell term 100% of the time, and the only company that sells term 100% of the time, and the only company that teaches people to get out of life insurance, because life insurance is not a permanent need.
Okay, thank you. Emmanuel, quality costs. This is still from Rose. Quality costs money. If you don't spend quality money and take cheap shortcuts, your family will end up like mine. Death with no life insurance and your family in total chaos because you were cheap.
Looks like she's gone. They could have bought a permanent then when the husband canceled the term. It looks like she left. So it's unfortunate, but the program she should have gotten the real help from the onset. To be honest with you guys, most of the time I want to see term, which is the good product, they sell 10 or 15. 10 or 15-year term is sold for people who are in their 70s because the premium is high. That takes them into their 80s. Why would I sell a 10-year term to a 30-year-old guy? I tell all my clients, hey, this is something that only pays out when tragedy strikes. If you can afford the premium, go for the longest term. And we give up to 35. For my 13 years in this industry, I still haven't picked up a policy from a non-primary care company that's 30 or 35. They go for the shorter term, and they do that knowingly, so that when it comes time to renew, the client is frustrated and cancels. They pocketed the money for 10 years or 15 years.
Okay. Can I say something about that?
Please, go ahead.
Yes. So I am saying I work for a company that is like the Amazon of financial services. So every product, I shop the company, I shop the industry. Before I joined this company, I contracted a term life insurance with ROBC, and it was a 40-year term. I still have the insurance right now as we speak. So at that time, I didn't know much. I just went to the internet and typed, I wanted life insurance. Somebody from RBC called me. So I have that policy for 40 years. It's still here with me. I'm still holding on to that policy. I don't know why, but for some reason, I'm holding on to it. So when I joined this company, I saw that there are other options that could be permanent and having these features. I said, oh, okay, let me study. Let me see what it is. And when I saw it, I saw that there are features that can be used. And there are shortcomings of this policy. Like we said, every policy, either term or permanent, have shortcomings. So the shortcomings of each of these policies should not make each of them scam. The shortcoming of a term insurance cannot make term insurance a scam. And the shortcomings of the permanent insurance cannot make it a scam. Because if you have a permanent insurance or a term insurance, if death strikes, they're going to pay out, right? So the shortcoming, as Eben will say, is that you don't know the market. That is a shortcoming. Is that you pay more? That is a shortcoming. Is that this? That is a shortcoming, but it doesn't make it a scam. Please, that's my word. As well as the shortcomings of a term insurance does not make term insurance a scam. I work for both. I provide both depending on people's needs and their affordability.
Thank you.
If I may say something,
Okay.
maybe that scam, I don't know what you classify as scam, but to me, anything that you buy, if you buy two things and open and it's one, to me, that's a scam. So again, coming back to these policies, pros and cons, I still don't understand. Let somebody tell me if my math is not adding up. When you pay 100,000 into something and you happen to pass on and your family gets 70,000, did you benefit from that company? They refunded part of your money to you. So if you lose 500% of your money in the whole life insurance for the first 5 years, and you are locked in a low 2 to 4% rate of return, and inflation is 5%, how do you ever recuperate that loss? That is how I still don't understand. Maggie keeps saying that the insurance policy will pay itself, then the engine compounds. You lose 500% for the first years. You're locked in a low rate of return. You never catch up that loss if the rate of return doesn't beat inflation.
Yes, Brother Castro, I respect your points. I respect your ideas. What I'm also saying, I am an agent. I do well to find out what is the best for my clients from all the companies that I shop around with. So investments are the ones that you can choose for yourself. If you're going to choose investments for 2%, then you'll be knowing what else that you are putting together. And just to be honest with you, or not to be too mean, I don't know where your illustrations are coming from.
No, I don't deal with illustrations. Contracts.
I, for one, I deal with permanent life insurance. You don't deal with permanent life insurance, but I see that you bring some things up.
I've analyzed them in front of cash value life insurance salesperson more than they do, and they're selling.
I understand. I don't see somebody paying. It doesn't make sense to me for somebody paying 100,000 for 70,000 of payout. It doesn't make sense. We are not.
But these figures don't lie now. I showed on the screen. And
you showed on the screen.
The problem is,
if I pull up my illustrations and I show you, and they are something different from what you are showing, how are you going to reconcile that?
Good question. I had volunteered to mail you my insurance policy with my name on it. I didn't print a whole 108-page universal life to send to Maggie. That's why I say I send mine to you with everything highlighted. Secondly, because people don't know these things, when we find a client, educate them and replace, we say, hey, do you mind if I take your policy, cancel your address, your name, the policy number to educate other people? That's why I have all these policies. I don't spend my time typing illustrations to show the people. There are people on this panel. It's just that because of privacy, client confidentiality, I cannot mention it. There are people on this panel who have replaced those policies with them by making them call the company and they get the truth from the company.
So the issue here that you are presenting is not an issue of that product being a scam. It's an issue
No,
of agents.
it's not an issue with the agent.
The agents
No, the
hiding
agents
information
are
or
selling
agents not doing
products
their
that
job.
they don't know how they work, and they're spending time defending them.
So,
My
so it
issue
is
is with the
the agent.
products, not
So
the
it is
agent.
the
No,
it is the agent that does not know about the product to present to their clients before.
let me say it's both, because the company structures the product, doesn't show the hidden rules to the agent. The agent goes and sells, yet is spending time defending something that is not what is in the contract.
Okay, thank you. We'll call it quits there.
Yes.
Yeah.
The next question is from Cletus. The problem with whole life and universal life is that the clients don't know exactly how much goes into the insurance and investment. Cost of insurance goes as you age. I think it means goes up as you age.
Mm-hmm.
Yeah. This is Emmanuel again. Two different. This is another Emmanuel. Sorry about the mix-up. This is not a question unless my account has been hacked. Oh, sorry about that. Marjorie, why combine life insurance and investment in an insurance policy when you know it becomes complicated? To Margaret.
I think have we not touched on that question? I think we might have already talked about it.
We have.
Let me just answer her, because the fact that she's asking, she didn't get it. So combining a life insurance with investment, this is my own opinion and this is my evaluation, because I have those policies. Combining it is helping you to pay the premiums later in life when the cost of insurance is very, very high. So the investment in your contract is going to auto pay the premiums for you when you stop paying premiums after 25 or 30 years. That is for me, that is the reason why I will do that. Because there's one other type of insurance that is called a T100. That is the cheapest type of term permanent insurance. It's a term to age 100, but you need to pay premiums until the day you pass. Let's say I'm 98, I'm still alive, and I have a term 100, I'm still going to pay premiums at age 98. So that is the cheapest type of permanent insurance that is available. That insurance has no cash value, and so you have to pay the premiums until the end. But with an investment in your permanent life insurance, that investment is going to compound over time and pay your premiums until the end of life. So that an investment is the engine of driving that insurance autopilot to the end of life without you having to spend more money.
Thank you. One last comment here. Please keep them coming. This is from Gautier. For both insurance types, do clients get a copy of the contract for reading before signing? How much time do they have to review before signature? I think it's for both of you. You have maybe 20 seconds each.
Well, unfortunately, permanent life insurance contracts are thick. Like mine is 108 pages. They have a 10-day free look period. With the crazy lifestyle we live here, how many people can go through a 108-page contract that's worded to confuse clients? Doesn't happen. They do that knowingly because they know people will not have that time. My term life insurance is 22 pages, but we have a 20-day free look period to go through. So you can at least read a page and a half a day, and in 20 days you'll be done and decide whether to keep it or give it back.
Okay.
Margaret?
So our insurance contract, just before we put the application, we tell the clients all the features, we fill the forms together. And if that contract is being approved, we send it to them for contract delivery. They have 10 days free look just to say they want the insurance contract or not. It's not by any compulsion, it's just by law. Law says give them 10 days. But my company gives about 30 days for that contract to be accepted. So all those 30 days that you have time to read the contract and say yes or no. I personally, I do get contract refusals. We applied for it, we said everything about it, we send it, the contract is approved, I send it to the client and say, read the contract, make sure you want it, and we bring it, and they come back and say, you know what, something changed in my life, I don't need this contract anymore. We send the contract back to the insurance company and say client refused. So they have 1 month until the last delivery date to read the
Quick
contract.
question, very
Yeah.
quick.
Yeah.
Margaret said she represents companies and shops around. And he said the law says give a 10-day free period. Are you saying that we are breaking the law by giving 20, and then you ended up by saying your company gives 30? So how can you be representing
Excuse me.
companies?
Excuse
and
me. When I say the law says, it's not like the law. What we read in the books, we read in the books to write the exam, it says 10 days free look. But when we deliver contracts for all insurance companies or for the companies that I represent, they give a 1 month end of delivery, which means that client has all that 1 month to read and accept the contract or not. So when I say the law, it means the book that we read to answer. It's not like it's the law that is shared to all insurance companies.
Okay, thank you. Comment from Ruth. Ruth N. I agree with Margaret. It's an issue with the agent. There are agents who focus more on getting higher commissions, so they sell clients products that are very costly and sometimes products that the clients don't need. Okay, I don't know if anybody has a question. That's it for the chats. Do we have anybody who has their hands up?
No hands up, but
Right.
I think we're about to round up, right?
Yeah.
So before we do, I know we've talked a lot about information. So when you go to meet the client as an agent, is your sole purpose to go try and sell a policy or to educate the client on the importance of getting a life insurance policy generally? I'll put the question to both of you. And if the purpose is to educate, what kind of conversations do you have when you meet the client? As briefly as possible. Who wants to go first? It doesn't matter.
I don't mind.
Okay, go ahead.
First, in our company, first thing, we don't sell at the first visit. We educate. Secondly, like I said earlier, we run a financial needs analysis. We analyze the client's situation and even know what they need before we go ahead with any sale. I would not sell life insurance to a 24-year-old Calgarian who lives in the dad's basement here, has no kids. They don't have a need for life insurance. But you guys saw me show a policy for a 2-year-old. We are dealing with an industry here that's just chasing commission. We run a financial needs analysis. If you need life insurance, we issue it. If you don't, we set you up an investment, because a guy who has no spouse, no kid, when you die, life is done. What do you need income protection for?
Okay. Okay.
Can I go ahead?
Yes.
Okay. So we just as my colleague have said, we educate and find the needs for their insurance. For young kids, I am a fan of insuring young kids because it's a protection against financial difficulties. If a young kid should pass away, where does the financial burden go to? It goes to the parents. And so if the kids are insured in a life insurance, like the kid module, that money is coming to help the parents to deal with the final expenses, to deal with the stress that they're going through. If they have to stay out of work to get their mentors situation right, if they have to stay and mourn, they can be able to pay their bills from the check from the insurance companies. So that is one of the reasons that I educate the whole family that each and every member of the family should protect the rest of the family members against financial stress. And also, for one thing, if my child is protected, if I have insurance protection on my child, I am not going to sit around the world waiting to get that insurance payout when my child passes away. I like my child to pass away at 90, 100. And so that benefit is going to go to their own children. And that is a generational creation of wealth right there. My children are covered. My children's children are covered. So that is why, for me, if I give insurance, I cover children with insurance. That is one of the reasons. Thank you.
Thank you very much.
I hope on that note, on that note, people shouldn't think that we don't insure kids. But let me break down here the difference.
Okay, sure.
We put kids on the parents' policy as a rider, just like you driving your car with a spouse in front and kids behind. Why? Because kids don't work. What I see typically with the rest of the industry, they'll go into a house, you have 5 kids, they issue 5 policies. 5 policies comes with 5 premiums, and times are hard out there. With us, whether you have 100 kids or 1, is 1 premium because the kids are not working. And if the kid still passes away, they still pay out for the parents to give the kid a befitting burial.
Thank you.
Can I just say something very quick before we go, just so that I don't miss it? Okay. He says if you go to the house, kids don't work, insurance company typically, that's for information purposes, typically they don't insure something that is not lost. So income is going to be lost, and so they insure that part. For kids that have policies, the income of the parents have to cover for that. If they don't, then they could not issue. I am in the shoes. I have done it. I've applied for children's policy, and they underwrite the parents for their income. And so children, they don't go on their own, they go on the parents. That's what I wanted to say. Yeah.
Okay. Just comments on the chat. This is from Marilo. Clients are different. Some have knowledge, others do not. There is no one size fit all in this. Then she goes ahead to say, I have term insurance with my kid as a rider, and I am not satisfied. Every family has their needs, and how they want to cover that depends on them. Cletus says, it's worth knowing that whole life and investor life pay more commissions than term. That's why most agents push them. Okay.
I have a general advice for your audience.
Yes, sir. Go ahead.
Because I have to get out now too. So
we're on.
If you're done, then let's do. This is the final closing remarks.
Closing remarks.
Yeah. Closing remarks. 2 minutes. Castro, because you went first, I'd like Margaret to go first this time.
That's fair enough.
Okay.
Margaret,
so thank you very much for the organizers of this talk. I'm very happy for the knowledge that we have shared here. I just want to take this opportunity to share something that I read, why rich people get richer and poor people remain poor. The rich take advantage of opportunities, while the poor think that every opportunity is a scam. I think most of us on this call have heard some of us say, oh, the Indians are making it. They have something, they know their secrets around. But let me tell you that they are simply making use of the futures of permanent life insurance. Families, they use it to leave an inheritance for their children. As I already told you, a good man leaves an inheritance for his children. If I buy a life insurance for my child, that's already an inheritance for their own children. If you want to go to read the Bible, Proverbs 13:22a, that's where it says. And for self-employed professionals, as I mentioned before, doctors and lawyers, they use the permanent insurance to have liquidity during their retirement. And also, if you are on this call and you have term insurance just because somebody told you that it's a scam, I can inform you now that permanent insurance is not a scam. You can go feel free if you can afford it, upgrade to your permanent insurance because it's not a scam. There is more and more benefits to it. I've already said it. So this is my point. Permanent insurance is not a scam. It depends on your needs. It depends on your affordability. And as someone said on the chat, insurance is not a one-size-fits-all. Let people find their options and situate themselves. If you cannot or do not understand how the permanent insurance works, stay away from it. Those who understand, go for it. Thank you.
Thank you very much, Margaret. 1 minute, 45 seconds. Castro.
Okay. Thank you guys very much for organizing this. And thank you to the audience for spending their time listening to us. If I have one advice for all of you attending this Zoom, get a license. If you get a license, you cannot cheat yourself. You understand all these gimmicks in the industry. If you don't want to do the business and get paid, at least you will learn and you know what is good for you and what is bad. Like all those comments, not one size shoe fits all. I don't understand how my sister will sit here and say she sells both term and permanent, but all through she's been pushing permanent. So
I am not pushing permanent.
Get a license. Yeah, get a license. Anybody, it doesn't cost money. And if you want to know the truth about this industry, carry an empty briefcase, go down to the Edmonton Court Hall, those that are in Edmonton or Calgary, go down here and say, you want to know the lawsuits in the insurance industry. You pay $15, you'll be shocked at what you're going to carry home. Thank you.
Thank you very much. Before we go, Margaret, how can people contact you?
My phone number is 5. Let me just share this number. Let me just share the screen here and I'll show you my phone number. Give me a second. That's my phone number right there.
Thank you.
Thank you very much.
Margaret Tawani. Castro, can you please stop sharing?
Yeah.
Castro, how can people contact you?
Well, everybody in this on this call must belong to that forum. So I've sent my card a few times. I'm sending it again.
Thank you very much.
Welcome.
I want to thank you, Margaret, and you, Castro, for the wonderful presentation. We learned a lot, and we're very grateful to have you guys come and share your expertise. I want to thank the audience, too, for having listened to close to 2 hours now. Thank you guys for your patience. Thank you guys for your questions. And also, I'd like to say this is recorded. It's going to be posted on the forum. You guys can rewatch, and the conversation can keep happening on the forum. Again, I would like to thank the founder of the Proud of Who We Are, our Better WhatsApp group. It's a great forum. Our Betters of Cameroonian origin, there's a lot to learn there. Again, to you, our faithful audience, if you have any topic that you would like us to do, like guests to come on and discuss, and you have an interest in, please let us know. Thank you again for this great exchange. You have something to say, Castro? You're muted.
You're muted.
Important. Anybody here also who owns a life insurance policy, I don't care where you bought it from. If medicals were not done, you shot yourself on the leg. You were flushing your money down the drain. How does the company know you are insurable? Just like what you bought at the bank over the phone, Margaret. The bank doesn't care. They're there to make money, not to make you and I get money. They could give you 500,000 for 40 years, taking $5 a month. If they get 1 million clients paying $5 a month without policy, how much are they making? But when we're getting old, our health changes, right? When it comes time to pay, that's why they do a post-mortem underwriting, and they say, how did we know you didn't have this when you bought that? Because you bought it over the phone. So if you have insurance that you didn't do medicals, sorry, it's not a binding contract. Because when you buy a car and call to insure it, the first thing they ask is a VIN number to know if it's stolen, aftermarket, roadworthy. And in life insurance, that VIN number is your blood and your urine. Thank you.
Thank you so much, Castro. I really like what you said at the end, that if somebody wants to know the truth, let that person get a license. I think I love that. I love that. That's my call to everybody. Go get a license. You know what is best for your family, at least. And just to say what Rodrigue said, if we want to have some other discussions on this forum, there is one thing I'd like us to discuss. One, if you own a life insurance policy, either term or permanent, you need to take good care of yourself. If you are a beneficiary on a life insurance, you need to take care of the life that is insured. Why? This insurance may not pay out if you are reckless with your life. And that wouldn't say that it became a scam, but because you didn't take care of yourself. So that is something I'd like us to discuss on this forum. How do you take care of yourself if you own a life insurance policy? I don't care, term, permanent, you need to take care of yourself. There are things that are in the contract, there are things that are not in the contract, and they will come finding you if you do not know about them. Thank you.
Thank you very much. Please follow us on social media. We are on Facebook, on Instagram, and on YouTube, the Idle Park Talk Show. We would like you guys to subscribe to our channel. Thank you, ladies and gentlemen. It was a wonderful presentation, and do have a wonderful weekend and the upcoming week. See you.
Bye. Have a great one, guys.
Thank you. Yeah.